Hello, everybody. Welcome back to yet another episode of the Young Investors Podcast. If you are a regular Spotify or Apple Podcast listener and you normally just listen audio only, definitely go and check out the YouTube version of the podcast for this week because we are live from Hamish's second bedroom. I've come down to Melbourne. I've come to the land of the COVID. And here I am. Here you are. How you going, mate?
Oh, it's good to be back. When's the last time that we did a live podcast? Man, it must have
a while ago.
Was it last year or was it before?
I don't even know if we did one last year.
Yeah, I don't know.
It might have been.
I should have looked that up before we started because it feels like it's been a long time.
We're at the studio. Last time.
So we did a couple down at that studio, which we just kind of hired out for the day. But yeah, now I got this bedroom, so
may as well use it.
This extra bedroom may as well. I think this setup's pretty good.
Yeah, I hope the audio will be okay. But
I hope so. We're not used to holding the microphone up, so
yeah.
I'm hoping I don't start just kind of
you just forget about it and have the mic on the floor and anyway, I was thinking about this thing.
But what was it I think it was that first podcast we did at that nice studio that we hired out where we were talking about the idea of being able to have a podcast space, like a dedicated podcast space. So this is like the closest we've
it's pretty close.
It's pretty close, right?
Yeah.
Like, I don't think I was in a different place at the time. So now I'm in a bigger place where we have the space to do this. It would be cool to have a permanent setup in here. Pretty expensive, I think, but I mean, I guess you could just putting the cameras in. If I got a tripod and I just had to move the camera onto a new tripod, that'd be pretty good. We can get some stuff in the background here, a little bit of stuff. It's a pretty small room, but
yeah, it works though. You don't need that much space for podcasting.
No, not really at all. Yeah.
But here we are. Now I'm looking back at Audition. So what are we talking about today, Hamish?
What have we got? Yeah, we've got
inflation. That's what we've got. We've got to talk about inflation. As we always do. Seriously, the last year of this podcast has just turned into the inflation podcast.
Inflation Jerome Powell.
We just talk about it
podcast
all the time. Well, there's always stuff to talk about because it keeps going up. Spoiler alert. So we'll talk about that. I'm going to talk about maybe a little bit on Manhattan rents because that will surprise you. Of course, Kim Kardashian, Floyd Mayweather. Did you see that with their getting sued over the crypto stuff? Yeah, we'll talk about that.
Oh my goodness.
What are you talking about today?
Yeah, I've got a couple of things. I got a fun story about how much money Australians think they need to feel rich. So we can kind of talk about that. And then an interesting kind of look back at 2021 corporate earnings. So looking at the S&P 500 in the US, because the markets went up a lot last year in the US.
They did.
So was it justified? We can take a look at and kind of have a look at that. So
bit of a comparison.
Yeah.
That'll be interesting. All right. Hey, do this. Now you got to do the sponsor segment live.
Man. Do you reckon I've got it off by heart now? Do you reckon
try not to look? I mean, you can probably get through it. It's not that hard.
Let's see. Okay. Today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically or manually using Excel. And once you do, it will allow you to track all of the different types of gains that you experience as an investor.
What
Capital gains? What gains, Hamish? Capital gains, dividends. If you have a dividend reinvestment plan, it will do all of those calculations for you.
It will.
I'm doing well.
Yeah,
currency gains. If you have shares, if you're buying shares internationally or you hold foreign currencies. And then the main reason why I use it is when it comes to tax time. So Sharesight generates up to 12 different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. I got the link right.
Yeah, nice.
/young investors. That's site spelled SIGHT. Sharesight.com/young investors. Use that link, sign up to a free plan, track up to 10 holdings for as long as you want. Or you can sign up to a paid plan for more premium features and get 4 months off a yearly subscription.
You nailed that. Yeah.
I've done that so many times. I wonder how many times it's got to be like 100 times we've done that now, at least.
And I just make you do it I never do it. I think I've done it once. But when you say it in our normal podcast, do you just read?
I guess 7.
You have it right in front of you every time.
I have it right in front of me every time.
Okay.
Yeah.
So that was a true test, but yeah, you definitely know it. You definitely know it.
It's definitely right in there.
Back to front, upside down. Yeah, exactly right.
All right. Where should we go? Where should we begin? Actually, one fun thing, just a very short thing. This isn't really a news story, but I wanted to give like a kind of a flashback to one of our other live podcasts where we spoke about Hometown International.
The one
and only deli in New Jersey.
Literally the one and only deli of this publicly listed company.
Yeah, exactly. One deli. So it was a publicly listed deli, and the CEO was the only person in the company. He was also the wrestling coach of the school next door. It was this insane story. And the business had, what was it? It was, I don't know, I think maybe 20, 40,000 in revenue or something like that.
Right.
Basically, it's a deli, right? It's doing, all right for a deli. And
I think at the time you said it had done like 30,000 in revenue for like across 2 years.
Yeah, it was something like that, something ridiculous. And it had a market capitalization of, I think at the time, $105 million. So it was just a crazy example of market exuberance. So I just remembered that, and I was like, let's have a look at what the market cap is now. What do you think? Have a guess. So obviously it shouldn't have, probably even in the millions, right? But like, what do you think? Is the market it's been what, a year maybe?
Yeah.
So
I'm going to say something crazy, and just based on the fact that the market back then was like here and now it's all the way up here, I'm just going to say it's gone up like 20%. But I have no idea.
It's like 120 million.
I mean, realistically,
like
it should be non-existent. It should be bankrupt. It should be gone. Kick it off. Yeah, but
get it out of there.
Yeah, exactly.
Well, yeah. So I mean, it's still listed. It went down.
Oh, really?
But not by much.
Oh,
it
serious?
is today. It is 97 million. So
97.
Yeah,
it makes you want to start a deli, doesn't it?
Yeah, it does. Yeah. And speaking of, second sponsored segment of today.
Today's episode is brought to you by Hometown International.
Sharesight delis.
Sharesight delis.
They're expanding.
Yeah, wow. Okay. That's just ridiculous, isn't it? It's still 97 million market. Yeah, it's a lot of dough.
Yeah. It's
he should just sell. He should just sell. Make some cash, make some coin.
Yeah, I mean, it's up there with a Rivian. I mean, Rivian's obviously a gross example of market exuberance as well.
Yeah.
But Rivian's coming down. I think they're in the $80 range now. They were at 160 or something like that when they first went public. So, yeah, the market's kind of it's starting to head in the direction which I would expect. But yeah, where it goes from,
I wonder what happens
now.
Like because the market feel like they're anticipating 3 interest rate rises this year, so they're kind of like, oh, okay. I wonder like if anything happens when the Fed comes out and says the first interest rate rise is here, everybody, or does everybody just know to anticipate at this point that, and the market just won't react when it happens?
Yeah, well,
I don't know.
It has to be on expectation, right? So the expectation right now is 3 rate increases.
So you feel like if that happens, then they won't. The market won't panic too much.
Yeah. So, I mean, I think you're probably going to talk through what the latest inflation numbers were, but the numbers were fairly much in line with what expectation was. And the result of that, even though the inflation numbers are crazy, like the actual number is insanely high, the market reacted quite positively, actually. Over, I think it went down earlier in the week and then it kind of rallied after the meeting. So,
7% inflation. Oh, that's we were expecting worse. Good. Should we talk about it?
Yeah, take us through kind of the numbers and then
I'll get to the story. So yeah, we did get the latest inflation data, as we do around about the 10th or the 12th of each month. Yep. I think the dates differ slightly each month, but so the US inflation is now up to an annual rate of 7%. So it was at 6.8, it's now at 7. It says the consumer price index, a metric that measures costs across dozens of items, increased 7% according to the department's Bureau of Labor Statistics. On a monthly basis, CPI rose 0.5%. So for those that are kind of seeing, 6.8 going up to 7 and saying, oh, it's slowing down now. I mean, if you annualize the 0.5% monthly inflation, it's still 6%. So Yeah.
Yeah. So we had, I think, so the 2 months prior, I think it was maybe like 0.8, 0.9 increases. Is that, do I have that right?
I can't quite remember.
I
actually.
remember one being 0.9, I think.
Right.
I'm almost certain one of them was 0.9.
Okay.
So yeah, the monthly rate, the 0.5 is still an insane amount to go up in a single month.
Even if the monthly rate's gone down a little bit, it's still still bonkers.
Yeah, I don't know exactly what it would be, but it would be like 0.1 or 0.2 is what would be per month to keep us in that 2 to 3% range. So that's what we would be happy to see on a month over month basis. 0.5 is still, what did you say? It was an annualized rate of 6%.
Yeah, 6. Yeah.
So, it's
pretty insane. It says here that the annual move was the fastest increase since June 1982 and comes amid a shortage of goods and workers, and on the heels of unprecedented cash flowing through the US economy from Congress and the Federal Reserve. Well, we know that. We certainly have spoken about that.
Yeah, and you've got to keep in mind, when we say it's the fastest rate since 1982, we're comparing two metrics that really can't be compared, right? If you use the same measures that they used in 1982, I would imagine the rate would be actually much higher than it was at the time, because last month the 6.8% was more like 17% if you're using the 70s, 80s measures. So
that's insane.
Yeah, it is kind of, I don't know. It's all very strange. Once I heard that and realized how different they compared inflation back then to now, every time I see like, highest rate in 30 years, I think, it's more like highest rate in 100 years or something. Like, what is it really? And I mean, look, here's the thing, like how they track CPI is never going to be perfect, right? Like the price you pay for an amazing 4K TV today is obviously a lot more than what you would have paid for a brand new box TV, let's say 10, 15 years ago. So it's really a question of how much of that price increase in the TV is because the product is better, because the TV is better. So you would be naturally be willing to pay more for it. How much of the price increase is because it's actually a better product than the previous product, and how much is inflation? And doing a division of like, is it 40% of that increase is inflation and 60% is because the tech is better? You can't.
It's hard to know.
You cannot possibly do that calculation. You could do the same thing with like a smartphone. Like you're willing to pay far more for a smartphone than you would for a little Nokia phone, 20 years ago. But part of that is because the phone does more things. You are more productive with it. But part of it may also be would be inflation. So it's like there's no real way that they can make an actual measure of what inflation is. So you just end up with these numbers that you kind of rely on, but also you probably shouldn't rely on too much. I don't know. It's difficult.
It's all a bit roundabout here and there, a little frayed around the edges. But I mean, it's like you just got to do the best you can, I guess. And I can kind of understand. This goes back to what the Fed was doing, Jerome Powell, how he was doing like the trimmed mean measures of inflation,
that's right,
where he'd like cut this out and cut that out and eliminate this and add in that. And it's like, well, you can really manipulate this data as much as you want to make it look how you want it to. But at the end of the day, there's probably an argument to be made that there should be some manipulation, I suppose, because it's what they're trying to do is that at the time they were trying to get rid of the inflation from the short term, maybe it's not so short term, supply demand. And they were trying to get to the underlying monetary policy inflation.
Yes, exactly. I mean, like you look at something like petrol prices or fuel or like petroleum prices, and it's just the chart is like this, like throughout the year. So like, you look, if you actually include everything, then when you look at a single month, it just doesn't really tell you all that much. That, of course, there has to be some level of adjustment, and they decide what they want to adjust and what they don't want to adjust. And in the end, it's like you could be like, no, but I would do it this way.
Exactly.
And someone else would be like, no, but I would do it this way.
Yeah, exactly. What's your inflation figure for this month, Hamish?
Mine's 47%.
Oh, mine's we're in deflation at the moment, Hamish.
Everything's
that's
fine.
my measure. Yeah. Oh dear. There you go. So inflation's going up a little bit more. Is there anything else to talk about with this story? I mean, we've spoken enough about inflation. I think we've spoken, or I've said my piece on inflation. That's the news, really.
Yeah, okay.
It's gone up slightly.
Yeah,
You had something to add on.
Yeah, well, on the back of that, Jerome Powell, of course, the head of the Federal Reserve, this week he testified at the Senate in Congress.
Okay.
And he was asked a bunch of questions around inflation and interest rates and fiscal policy. And he said some things that were really interesting. I'm going to read a few quotes just off the document here, just so that I can get these right. One quote from him was that if inflation remains high, Americans should prepare for a recession. So that's pretty...
Don't say that word, Hamish.
I mean, that's a big change of tone from, let's say 12 months ago. And he's just going, oh, everything is transitory, it's short term. Now he's saying we should be, we should really be thinking about the idea that there could very well be a recession. Can't remember the exact numbers. I think inflation in the US has gone above 5%, I think 11 times over the last century or something like that. And 7 of those times it was followed by a recession. So that, you could put that at, 75%, 74% chance that with this level of inflation that it goes into a recession.
And I would imagine he's talking about that from quite a technical perspective, because I think people get very scared when they see the word recession. But I think recession, what's the technical definition? It's negative GDP growth for 2 quarters. I think it's two back-to-back quarters.
Yeah.
So, I mean, a recession can be, obviously, we think about, the recession in 2008, and it's like, oh my God, we can't have another recession.
The world's ending, yeah.
But yeah, a recession, if you want to follow a technical definition, may not actually be that bad.
Yeah.
But I think it makes sense what he's saying. Yes. If and what you were saying before, what were the stats again? So many times that the inflation's been over 5%.
Yeah, I think it was 7 out of 11 times that inflation has been over 5% in the US. The US has gone into a recession. So, yeah, most of the time. So then another quote there from the meeting was, if higher interest rates get entrenched in our economy, if higher inflation gets entrenched in our economy, that will lead to much tighter monetary policy. So
makes sense.
Essentially, he's laying the groundwork here, like he always does with everything, for the idea that there could be more than 3 rate hikes this year. I think he's we're a couple of weeks into the year. It was only a month ago he said 3 rate hikes, and he's already saying we could be more aggressive. We could be more. He's already laying the groundwork. So I think he's just preparing for the idea that ultimately we don't know what inflation's going to do, and it could get worse.
I think it makes sense for him to adopt that strategy of acting, because so many opinions hinge off of what he says. So I think he wants to try and, if there's going to be changes, if say they're printing money and then they're going to go to raising interest rates, he wants to try and smooth every move out as much as possible, if that makes sense, just so that nobody's caught, because it's the panic that makes things really change quickly. Like panic in the stock market makes it move very quickly. So I think he just wants to try and just be very smooth. It's like, okay, I'm just going to plant the seed right now. And just be like, okay, we could act more aggressively. I'm not saying that we're going to, but we could act more aggressively. Then in a couple of months' time, it won't come as such a shock when he says we're acting more aggressively.
Yeah, exactly. It has to lay that groundwork. And then, so then there was an interesting kind of back and forth in regards to government debt, because of course that's a big concern. If they're going to be aggressively raising interest rates, then the interest payments on government debt, which is at I think $28 trillion or something like that,
it's quite a bit.
Will be going up. And for a very long time, those interest payments have been very, very low, like 1-2%. So, if that goes to 5-6%, all of a sudden, it's what does that look like?
Yeah, true. Hey.
For the government. So Republican John Kennedy said Professor John Keynes, who is obviously a famous economist, said one way to get out of a recession is to have the government spend money that it doesn't have to stimulate the economy. So he's talking about this idea of using debt to stimulate the economy through fiscal policy. That is, obviously what the US government has done historically over time.
Yeah, he's looking to do that. Yeah.
He went on to say, but he also said something else that the media doesn't usually quote. That when we get out of recession, you have to pay the damn money back. Didn't he say that? And Powell responded, yes, governments can be in deficits during bad times, but should be in surplus in good times, essentially saying that when things are going well, the government should be looking to pay down debt rather than continuing to increase it. And that is something that just has not been played out over the past 30 years in the US. Every time there has just been a consistent amount of increases in debt. And because governments want to spend money. That's how they stay in government. I mean, they do things for people. They spend money for people. They make people feel good about all of these things that you have and these new things that the government's doing for you. And then people vote for you.
Yeah. So. As Warren Buffett, he said in the 2021 Berkshire meeting, he was like, well, if you can tap into a lot of money and you can just give it to people, well, that's going to earn you some votes.
Yeah.
It's like you take the average person, I'm getting a relief payment of $800 and I don't have to go to work or anything I just get it. Who said that? Oh, Joe Biden did. I like that guy.
I love that guy.
That guy's great. I might vote for him. But yeah. And then obviously people don't realize that in a roundabout way, yes, it goes through some steps, but we all end up paying for that money that gets given out to everybody. Like everybody pays if the government's going to give out $800 per person, we're all going to pay for that.
Yeah.
But they just try not to let people know.
Yeah, we're going to pay for it in one way or the other. It's either through the devaluation of the dollar, which is what Ray Dalio is expecting to happen.
Tax hikes.
Taxation.
Yeah.
Yeah, there's
multiple ways.
It always comes back.
It does.
I mean, economics is like, I think it's like the physics of money. Right?
It is. Yeah.
You can't break it.
Yeah.
You can't beat it. You can't game it. Eventually, it comes back.
Yeah.
And for those just wondering, I mean, government debt works pretty similar to other kinds of debt that you would like personal debt or business debt. If they get desperate for more debt because let's say interest rates are rising, so the interest payments on the debts they have are going up. And they are desperate for more money. If you're desperate for debt, you will demand or you'll be willing to pay a higher interest rate. So that means higher interest rates on government bonds, 10-year government bonds, 2-year government bonds, and high interest rates on those bonds is, that's like gravity it works in kind of the inverse to stock prices, right? If all of a sudden you can get a 10-year bond from the government that's risk-free because they've never defaulted for let's say, 6%, why on earth would you buy a stock to make 7%? I'm just going to buy that bond and sit back and relax. And that selling pressure is going to could put a lot of downward pressure on stocks. So that's kind of what we should be thinking about. Yeah.
As I was just going to say, that's why I think about it like a sliding scale. As like bonds are over here, bonds are on the left, stocks are on the right, and it's like as interest rates go down and bonds get trash, then all of the big money comes over to the stock market side, and then the opposite as interest rates go up and bonds get more enticing. All the money kind of comes out of the stock market and goes into goes back into bonds. And obviously, if that happens with a lot of cash, then you just get a lot of selling pressure.
Yeah.
But it's very interesting.
All right.
Interesting times ahead. Next 2 or 3 years. I wonder. Like I know we made a prediction just for fun last week, but I do wonder like. How high do interest rates have to go to actually stop this inflation? Like I remember talking to Jason, who was telling me about how America handled it in the 1970s. How it's like, they had like huge inflation. Inflation rate was like 15%. So the chair of the Federal Reserve at the time, I think his name was Paul Volcker. He comes in and he raises interest rates to 20%, and it worked. Yeah. And I'm like, I don't know, maybe that was overkill. Maybe you only had to raise it to 10%, but I don't know. But it's just like, how much do you have to raise interest rates for inflation to actually cool off? I got no idea, but it'll be interesting to see.
Yeah, we don't know. No one knows the answer to that question. That's really what, and like you said, I mean, we've talked about inflation and the Federal Reserve for so many podcasts, but this really is the biggest issue that is that's going on at the moment in finance. It's the number one issue. It's the number one thing everyone wants to know what's going to happen. And we just don't know. We really haven't seen it play out like this in a long time. So do interest rates have to go to 12%? Are we going to see interest rates go up this year and inflation continues to rise? And then we're like, We just put interest rates at 1.5%. We did, 3, 4, 5 rate hikes, and inflation went to 8%. Uh-oh.
Yeah.
What do we do now?
Keep going.
Do we do 3 rate hikes and inflation plummets over the course of the year?
That would be interesting.
And it goes back into the range, and then maybe even it starts to slow down, and the Fed's like, well, you know what? We'll actually, we'll just chill here for a little bit, and the market would absolutely love that. And we don't know what's gonna happen.
I certainly don't know. I wish I did. I think if Peter Lynch said if you can predict interest rates or whatever, if you predict their direction 3 times right in a row, you'd be a billionaire.
Yeah.
And considering there aren't that many billionaires in the world, I figure you can't really predict interest rates. It is like, that's smart.
It is insane how much of an impact it has on all asset classes. Like everything is kind of linked in a chain of risk.
It is, yeah.
And it starts with interest rates, the lowest risk-free alternative, and it just goes up the chain. If the risk-free gets a bit better, people start to move money a little bit down the line, a little bit safer.
Yeah, the government bond is getting more enticing.
Yeah, like, I'll move out of these risky stocks into safer stocks, and I'll move out of these safer stocks into bonds. Like,
it is just a sliding scale of money.
Yeah, it's crazy.
Very interesting. Anyway, we'll have to keep up to tabs as we always do. To be honest, I'm kind of getting a little bit over it, like talking about inflation, because we just talk about it all the time.
Yeah.
But I guess it is probably the most pressing economic finance related issue of, the last year, and it'll probably be the same in this year as well.
Yeah. Yeah. I just find it so interesting to just watch what's happening, because it really is like very core economics, what we're seeing play out. We're kind of seeing
a good lesson.
Yeah, we're seeing the Federal Reserve do kind of the major things that they can do to control the economy, and then we're seeing what happens, what other things influence, what makes it go different to how the theory says that it would in an isolated environment, because that
in a perfect world,
in a perfect world. So it is very interesting to see how all of this is played out.
Well, we'll have more to talk about in another month, I guess, or Jerome will probably do something before.
Yeah, do we get a Fed? No, we don't get a Fed meeting in January, right?
Don't we? I don't know. It's like it's not a perfect schedule, because they meet like 10 times in 12 months. I don't know.
I think the next one's in February, unless I'm thinking about the Reserve Bank of Australia. One of them misses January. I'm not sure which one it is.
Who knows? Anyway, when that meeting happens, we'll talk about it. Yeah. All right, let's move on.
Where should we go from here?
I want to talk about Kim Kardashian and Floyd Mayweather.
What has she done?
Both of them. Floyd Mayweather as well. The article says Kim Kardashian and Floyd Mayweather are being sued over promotion of a crypto token. It's only a matter of time before a big celebrity got caught out. And you were telling me just before, Floyd Mayweather's been caught out quite a bit by this stuff before.
Yeah, I think he's done a few of them. Yeah.
So you would have thought you'd learn your lesson, but nope, just
straight back in.
Straight back in, baby. It's making me money. Anyway, article says here, reality TV star Kim Kardashian and boxing legend Floyd Mayweather Jr. are facing a lawsuit alleging the celebrities misled investors in their promotion of a cryptocurrency token. Class action lawsuit filed last Friday in the U.S. District Court for the Central District of California accuses Ethereum Max and its celebrity promoters of working together to artificially inflate the price of the token by making false or misleading statements in social media posts.
Uh-oh.
Yeah. So Kardashian included the hashtag ad in the message. So that clears you of all liability,
it's just an ad. Yeah,
it's fine. You stand up in court and say, excuse me, hashtag ad.
I rest my case. Yeah. No more questions, Your Honor. No further questions.
No further questions for today. Oh dear. So obviously hashtag and the message suggesting she was paid to promote it. It's not clear how much Kardashian was paid by Ethereum Max, though estimates have placed her fee per sponsored Instagram post in the, get this, $500,000 to $1 million range just for one post.
Well, that's what you get when you have 250 million Instagram followers.
Yeah, I know, right? Honestly, it does. I'm not surprised that they just agree. Like, I was thinking before, Kim Kardashian, she's got so many followers. She could just accept like a sponsorship from a clothing brand and wear their t-shirt or something. Or it's like, why don't you just, when you get to cryptocurrency, just let it go. Just let that one fly through the keeper. Just go get another sponsor. But I mean, I don't know if they're knocking on the door saying, hey, $1 million, easiest $1 million you'll ever make.
Yeah.
We've already made the post. We just need you to post it.
Yeah.
You can understand how people get influenced by money and then they just click. All right, there's $1 million. Oh, crap. I've accidentally just promoted a scam.
Yeah, and clearly a lot of these celebrities who do these promotions, it's incredibly popular now on Twitter. You'll just see like it's just kind of crazy the different kinds of celebrities that are doing these posts. Clearly, a lot of them have absolutely no idea what they're promoting. Like clearly there would be, and that doesn't make it okay. Obviously, you should do your due diligence on what you're promoting, but there's kind of a step difference, I think, between someone who does like a lot of kind of sponsorship posts and doesn't really think about it. That's just negligent versus someone who is like fraudulently involved in it.
Yeah.
Whether, I think this lawsuit is suggesting that they were involved in it. But we'll kind of see. It is, it's just horrible how many of these have gone through and there's just no regulation. Like, it's insane.
Yeah.
They just get pumped up. A lot of the time, the people who are promoting it are involved and they own a lot of the tokens.
Yeah.
And as soon as it gets pumped up, they dump all of their tokens and they get out. They make money on the promotion up front, and then they make money on the tokens that they were given for free.
So. You want to know what the post actually said? Like what was in the post? She said, wasn't that correct? Hey, it says, are you guys into crypto? This is not financial advice, but sharing what my friends just told me about Ethereum Max token. A few minutes ago, Ethereum Max burned 400 trillion tokens, literally 50% of their admin wallet, giving back to the entire Emax community. So that's what she posted.
Hashtag ad.
Hashtag ad. I mean, personally...
Can you really say hashtag ad and then say, oh, I just found out about this from my friend? Like, those two things don't...
Just sharing what my friends just told me. Yeah. It doesn't line up, does it?
But it's just an ad.
Yeah. Hashtag
But also
ad.
just between you and me.
Yeah.
This is going to the moon.
Yeah. Hamish just told me, we were just talking off camera before, and he said the Google Pixel 6 is the best phone ever. Hashtag ad. It's like you can't do it. Doesn't work.
Not sponsored.
Hashtag ad. He said, genuinely, this is the best thing you will ever use. Hashtag ad.
You couldn't pay me to say this. Hashtag ad.
Hashtag ad. Oh gosh,
man!
This is why we need to do more in-person podcasts. You crack me up. Dear, oh dear.
But yeah, I mean, oh man, even just the fact that she got paid she gets paid probably between $500,000 and $1 million for a story that expires in 24 hours is just mind blowing. But I think I don't know. I'm sure that's like really surprising to people who are completely out of social media. It was surprising to us, I think, but also I know how much money people make doing sponsored segments, like big creators, not as big as her, but with a few million followers or something. Yeah. There's a lot of money for being able to promote something where you have kind of a personal brand attached to it or something like that.
Yeah,
it's insane.
Yeah.
I just wonder how much she does for a post that stays on her on her
that
wall
would be
now. Or on a grid.
Many times more.
My goodness.
So that was Kim Kardashian. Mayweather endorsed the token in his boxing match with YouTube star Logan Paul. Ethereum Max was accepted as a payment for tickets to the event, a move the lawsuit claims boosted trading volumes sharply. Well, that definitely would probably happen. Mayweather also promoted Ethereum Max at a major Bitcoin conference in Miami and was subsequently booed off stage. It's pretty funny. Mayweather doesn't appear to have disclosed payment for his promotion of the token, the lawsuit said. It goes on to say Ethereum Max has lost about 97% of its value since early June, leading some investors to label it as a pump and dump scheme where scammers attempt to boost the price of an asset through false and misleading statements. The accusation features in the lawsuit, which accuses Kardashian and Mayweather of shilling Ethereum Max. What was interesting that I read in this article is that Ethereum Max has no connection to Ethereum.
Yeah, we were talking about this off air just before.
It's ridiculous.
The ridiculousness that there can be an Ethereum Max and there's just no consequence, like immediately for the fact that it's pretending to be related to Ethereum, which is a genuine cryptocurrency.
Yeah.
We're talking about how you could just make like, I'm sure there's like a Bitcoin or like a Bitcoins like with an S on the end. Like it's so scammy. It's just so bad.
It smells bad, doesn't it?
Yeah. Oh my goodness. It's what I'm curious about is if this goes to court and there's discovery where they each side has to kind of hand over documents and evidence to the other side, whether we will see at the crypto wallet level what was going on between some of these people, because that's the interesting thing about crypto is you can't hide it, right?
No, you can't.
Your bank statements might be private. Like if I transact with somebody, it can be private, but you transact on the blockchain and it is there for everyone to see, assuming you have their wallet and you can prove that it is their wallet. So it makes it really, really interesting. There's a level of transparency, but also it's difficult to figure out whose wallet's whose in a lot of cases, unless someone makes a ridiculous mistake. Like you see a lot of people on Twitch who stream kind of crypto related gambling, for example. They'll make a mistake where they'll accidentally share their wallet on stream. So like there's a lot of like crypto gambling sites and they put money in through crypto. So they'll accidentally share their wallet and then you can see what dodgy transactions they've been doing. Like you see like the company has been sending them money to gamble with and things like that. It's I've got to send you some of those clips, some stuff because like I am not involved in crypto from a investment perspective, but it is fascinating what is happening. It's like the underbelly of the finance world.
Well, it is because it's decentralized. So yeah,
there's just some crazy shenanigans going on.
All of the scams these days, all of them are Bitcoin. They're cryptocurrency.
Yeah,
I mean, it's that nobody's trying to scam you for US dollars anymore.
No,
it's like all of the the spam ads on our YouTube channels. It all ends up in a crypto scam.
Yeah.
It's all crypto.
Well, I mean, people know that it's just not regulated at all. And I mean, low-level finance is not regulated really well either, but like you take it a step further into crypto, it's the Wild West.
It is. Yeah.
It's insane.
Yeah.
And you just have to be really careful, even more so. So, yeah. That is a crazy story.
It is. I'll just quickly add just to show the other side of the equation. Let's see. A spokesperson for Ethereum Max disputed accusations that it was running a scam, stating the lawsuit was, quote, riddled with misinformation. This project has prided itself on being one of the most transparent and communicative projects in the cryptocurrency space, the spokesperson said. We dispute the allegations and look forward to the truth coming out. There you go. I guess we'll see. We'll wait and see. Yeah, but that's fighting words.
They're really kicking back. Yeah. Wow.
There we go. And also, as you were talking about before, I just thought I'd put this in. In 2018, Mayweather was charged by the US Securities and Exchange Commission with pumping an initial coin offering controversial crypto crowdfunding method. Mayweather paid over $600,000 in a settlement with the SEC without admitting or denying the regulator's findings. So, yeah, you're right. Not the first time he's been.
I didn't actually know that he had been fined by the SEC before. I was aware that he had done different schemes, but that's interesting. I wonder if that has any weight on the current lawsuit, or whether they have to kind of look at this one in isolation.
Unbiased.
Can they use? I guess not. I guess they're not supposed to take his kind of character and past.
Yeah, I don't think so.
I think they're supposed to look at it in isolation.
Just look at the facts. Yeah.
But I don't know. Yeah, that is.
But I mean, just for the general public, I mean.
Yeah. Come on.
He's been caught. He's been caught doing this before.
Yeah. And I mean, if it does go to court and it is decided with a jury, that matters. Because as much as, the court can try and instruct the jury to not listen to, things that he's done in the past in relation to crypto scams, they will.
Yeah.
And so
there you go.
That'll be very interesting. Here's a question for you.
Oh, yeah?
How much money do you need to feel rich?
Oh, this is very deep.
How do you feel about money?
How do you feel about your financial position? What stocks did you buy last year?
Hang on a second. Let me just get a pen.
How much money would I need to feel?
Do you feel rich now?
I feel fair from an.
I guess it depends. Like the word rich.
It depends. rich versus
With,
wealth, because we're kind
yeah.
of in that zone, I think, because our YouTube channels and our businesses are doing pretty well at the moment. Where I can't remember there's like a term for people like us, which are high income, low net worth, because we're at the start, we're young, so we've found something that works. So we've been fortunate in being able to get our income to a substantial level, but because we haven't had that income level for many years now, and we haven't had like you're saying, compounding time frames of investments and stuff, we're high income, low net worth. So I thought that was interesting. There is a name, colloquial name for people like that, but I can't remember what it is. But getting back to the question, how much money would I need to feel rich? I'm going to go from like a financial freedom perspective, and I'd probably say maybe 2 or 3 million.
Okay, so that's like from a wealth
perspective.
If this was your wealth, I would feel
my thought process is, if I had that amount of money, I could put it in investments that would generate enough cash
to be comfortable.
That I would be comfortable.
Yeah, because I guess the first time I read that, how much money would you need to feel rich? I guess I related rich to like feeling comfortable. I guess that's kind of what you're doing there. Yeah, I would probably say from a wealth perspective, probably similar. Yeah, probably a couple million, I think would be that point.
See, if you can get like a 3 to 5% dividend yield on a fairly healthy, stable kind of listed investment company, or even a dividend ETF, then you could probably.
Yeah. What about from an income perspective? So do you feel like right now what you make is, I don't know.
Yeah.
I don't just guess it comes back again. What's the definition of rich? To me, I would say like, do you feel comfortable?
Yeah.
Yeah. I would say that too. Yeah. I don't know.
I think for my lifestyle, which is not, I don't live a very lavish lifestyle. It's pretty basic, standard 26-year-old's lifestyle. I'd say that any income level over, say, like even 80 to 90,000, I would feel comfortable.
I would agree. Yeah. I feel like that was probably the point at which I felt more comfortable, probably around that. Yeah. It's really, I mean, look, I don't even spend that much money either. I think the vast majority of the money I spend is on like camera equipment, lighting equipment, for biz. It's like half kind of fun spending because I enjoy this, and then half because it's necessary for the business.
And we're also not in an environment where we can spend it. Like we can't go to America and have
spend a bunch of money
holiday.
on traveling.
Oh, whoops, I dumped $8,000 on a holiday to the US. Whoopsies. Like, can't do that.
Anyway, the reason I'm asking is there was a new survey from Finder of Australians that asked a lot of Australians kind of how they feel about money and what they would need in terms of income, not in terms of wealth, but in terms of yearly income.
Okay.
What would they need to feel rich? So the average person in the survey said that they would need an annual income of $330,000 a year to feel rich, which, to put that in perspective, is 7 times higher than the median wage in Australia. The median wage in Australia is $49,800.
I guess that makes sense, actually. I probably, I was looking at it more from I think if I wanted to feel what people would classify as rich, like when I think of what the average person classifies as rich, I think like Lamborghini, I think like, eating out at fancy restaurants every night, going to high-end places. I think if I had to answer like that, what do I think is rich? I think I'd say more like 200,000. But 300, that's a lot. 330,000.
It is interesting because I feel like the more money you make, the higher the bar goes anyway. Like I probably like 3-4 years ago would have said let's say the amount of money I'm making now, that would have been like insane to me. Like that would have been, especially for given my age. Like I would have thought, wow, that's crazy.
Holy smokes,
and I get here and it's like, it's great. I'm comfortable.
Feel the same.
I'm comfortable. I feel exactly the same though.
I feel the same as well. Yeah.
And the bar is now like high. Now I look at other, people making like 3-4 times what I'm making, and I think, wow, like that is, that's rich kind of thing. So it is kind of, I don't know. It's an interesting question. 1 in 4 people in the survey also said that they'd need $500,000 a year to feel rich. So,
wow.
A lot of people think they need.
Then again, I think it's like geography as well. It's like if you live in flipping, I don't know, the middle of nowhere. If you live in like Orange or somewhere, then your number's probably going to be substantially lower than someone that lives in Kirribilli or something like that. So
right,
but That's one thing to factor in. But yeah, that is crazy that was 1 in 4 people think 500.
All right.
That's a stack of cash. That is a big sum of money.
That's a lot of money to be making. I guess, and 500,000 a year, like income. So like that would, from a business perspective, you'd be making a lot more than that after expenses get to 500,000. So
yeah.
That's 500,000 after like pre-tax 500,000. That would be.
It's a lot.
That'd be nice.
would be nice. Would be nice.
Yeah. Anyway, we're a little bit more kind of detailed on different age groups and genders in terms of what people desire. So the Finders research found that Gen X need the most money to feel rich. So they need 354,000 a year. Gen Z, which I think is me, right? I think I'm Gen Z, right?
Yeah, probably. I think I can't remember the exact, but you're probably Gen Z. I think I'm Gen Y.
No, you'd be middle. Oh,
anyway,
I don't know. Oh, yeah, there's Gen Y as well. I don't know. Anyway,
I'll look it up while you're talking.
Yes, do that. Gen Z need a little less at 287,000 a year. So that's kind of interesting. But I guess that makes more sense if you're a little bit older. Maybe you have more expenses, more responsibilities. You're thinking about family more, so maybe you have kind of more of a desire for a higher income kind of thing. I don't know. Interesting.
I looked it up. Generation Y refers to millennials born between 1981 and 1996.
So that's you.
That's me. Gen Z refers to the Zoomers. It actually says
Zoomer.
That. The Zoomers born between 1997 and 2012.
God, I wish I didn't know that.
What year are you born in?
98.
98. Okay. Yeah. There you go.
Right on the line there. And then in terms of gender, women reportedly wanted slightly more than men. So women wanted 33,000 a year. And men wanted 319,000 a year. It's interesting.
That is interesting. I would have said the other way around.
I would have almost certainly predicted that it would be the other way around. So there you go. That's interesting. But crazy. I don't know. I just thought it was like a interesting little survey there.
Yeah, that is interesting.
To kind of see what people think in terms of income. Thank you, Finder, for doing that research for us.
Let's do our own survey. Go if you're watching us on YouTube, just drop a comment. What income per year would you need to feel rich? I'd be interested to see, because I feel like maybe a fair chunk of our audience is obviously pretty switched on to money and investments and that sort of thing. So I wonder if the consensus is maybe a little bit higher, than someone that you just pluck off the street. Yeah, I don't know. But anyway, let us know. This is very interesting. Go, and if you're listening to us on Spotify or Apple Podcasts, just quickly scoot over to the Young Investors podcast on YouTube and just drop a comment on this episode. We'd be interested to hear what you have to say. With that said, I'm all over the place in this Google Doc today. How long have we been going for?
We've been going for 48 minutes.
48 minutes. Wow, that has flown.
Oh yeah, it always does.
I love doing these in-person podcasts. Here's an interesting quick story. This just flew past my eyes and caught my attention the other day. Manhattan rents hit highest levels ever.
Great.
Manhattan rents hit their highest level ever for a December as supply of apartments plummeted and landlords started demanding double-digit increases in rent.
Whoa.
So, interested to hear your thoughts. What do you think the average rent? I think it's per month. Yeah, per month is in Manhattan.
Oh my God, that's such a hard question. I don't...
Expensive.
Oh, it has to be crazy. It would have to be average.
This is the average.
I mean, there's small apartments that really
What we see in the media is normally pretty high end. So what's the average? It's still Manhattan, so still very expensive. But
I have no idea, but let's say 3,500.
You're not far off. The average apartment rent in Manhattan hit $4,440 in December.
Wow.
Yep.
Wow.
While the more widely watched net effective median rent, including all discounts, hit $3,392, the highest level for December on record, according to a report from Douglas Elliman and Miller Samuel.
That is crazy.
The net effective median rent was up 21% over last year.
That's
Very
insane.
interesting. It says here the surge marks a dramatic turnaround from a year ago where there were more than 25,000 empty apartments for rent in Manhattan.
Wow. Oh, that's right. Because I think everyone left the city.
They left the city.
Because it was so horrible with COVID.
Yeah,
That's crazy.
It's very interesting. Long story short, the vacancy rate, which is normally about 2% for Manhattan, was 11%. Now the vacancy rate is 1.7%.
Wow.
With only 4,700 apartments available.
That is insane. That's
It
so
is.
low. 1%. 1.7% of apartments vacant. That just shows.
But that's kind of what I think when I think about places like New York, Manhattan. I feel like everybody is trying to go there. I don't know if that's just an opinion that I've formed from what I've never been there. So maybe that's just what I've formed, the opinion I've got from what I see on TV and on YouTube and stuff. But I feel like everyone's trying to go there.
Of course, yeah. I mean, everyone, like, a lot of people will start. I mean, in particular fields in particular careers, of course, in law, in finance. These are big careers in Manhattan, and everyone wants to go there to go to the big city, the city, to give their career the biggest chance to be as successful as possible. And I don't know I really don't know anything much about Manhattan real estate, but I know that they do have some kind of rent controls in some aspects. So it is kind of interesting to see that it's exploding so much. I wonder if some of those rental caps were lifted, or
Maybe.
or how that works at all. I don't know, but usually there is a massive shortage of apartments just simply because they have to put price caps. Otherwise, it would just be the prices would just be insane.
Capitalism at its finest. It would just be just all out. Yeah, you'd be paying a lot. The article didn't know either, but they hinted at a few potential reasons. It said brokers say demand is being driven largely by college graduates getting new jobs in Manhattan. Many poured back into the city last spring when the mayor announced that the city would reopen on July the 1st. Even though only about a third of office workers are back at their desks in Manhattan, the expectation of a return to office continues to bring in waves of people, brokers say. And another reason is that New Yorkers who sold their apartments and moved their tax residency to Florida or another low-tax state are also renting in the state now to keep a foothold in the city, to keep a residence there.
Right.
But they don't want to actually, I don't know, be a full-time resident maybe for tax purposes. Maybe there was a change in tax law or something.
Yeah, I don't know. Yeah, I'm not sure how that works.
But that makes sense if you're super rich, and then if there's a tax law change and it means you're going to pay heaps more tax, all right, I might move to Florida and I'll just keep a rental apartment here or something like that. So
yeah, well, I think, I don't know, there's obviously a lot of qualifications for where you're a tax resident, but I think one of them obviously is that you have to spend more than 50% of the time in that state.
Yeah, that makes
I know a
sense.
lot of people do that between Nevada and California, for example, because they're just so close. So you'll be able to live in Nevada and experience the lower tax rates than California. And then, you'd have like a 3-hour drive to LA if you wanted to spend like a significant amount of time there, or you had properties there or whatever it is. So yeah, interesting.
it is interesting. It says here, Jana, not sure the pronunciation, probably Jana Raskoff, leading rental broker in Manhattan with Douglas Elliman, says she recently listed a 2-bedroom for $12,000 a month.
Two bedroom.
Yeah, 2-bedroom for $12,000. She immediately had 26 people tour the apartment and had a bidding war among the renters. She said it will likely rent for 15% above the asking price, like many apartments she's listing lately. So very, very, very expensive. I don't think it's a place that I would particularly like to live. Well, I would like to live. That would be interesting. But the effect on the wallet, not such a fan.
Yeah, no. I think it would be fun to live in Manhattan for a period of time, whatever it would be, maybe a year or 2 years, probably not that long. In the same way that it would be exciting to live in a lot of different places. Like I would love to live, in Italy for 2 years and then here for 2 years.
That would be pretty cool.
Yeah, I would just love to experience a lot of different places. And I mean, with what we do, we pretty much could do that. So it would be
digital
exciting.
Nomad. Everyone wants to be one of those these days. But yeah, honestly, you could. Yeah, if you're just running the show yourself, you could just
It's obviously easier to be in one place. Like obviously it's very convenient to have a studio set up here and have everything at a base, but you could do it. Yeah, you could definitely do it.
That would be cool. Very interesting.
Should we'll do some Q&A.
Let's do.
We've got a lot of questions here from the audience, so we'll jump through.
We'll jump over the fence.
I'm getting tired.
And we'll jump into the Q&A questions.
I'm getting hungry.
Do you want to start with what one do you want to start with?
I'll ask you that one. Hey guys, when should I sell a stock at a profit? In Phil Town's book, Rule 1, he recommends selling once the price reaches the intrinsic value of a stock, but that does not align with the Buffett way. What are your thoughts on that?
I think a lot of his book, the original book, I think he talks about doing this all in a Roth IRA account, doesn't he?
Does he?
I think part of his book, so he's in there and because that's all tax free and whatnot. Right. So he's like, if you have a lot of companies, he's always assuming, I think, that you can find something that's cheap. It reaches the intrinsic value, then you sell it, and that's tax free, and then you can put it back in here because he's talking about the MACD and the stochastics and that sort of thing.
That's right.
And he was saying, look, you're in your Roth IRA account, so it's tax free forever, so you don't have to worry about that. So it's like you can just buy, sell, buy, sell, buy, sell, buy, sell. Whereas he doesn't talk about that anymore.
Yeah.
But no, I'm definitely more of the approach of Warren Buffett, where if it's a good business, you just stick with it. Yeah. I mean, it's fair, and I think we've said this quite a bit recently. I think we might have answered a similar question recently. If it's overvalued, you can sell it if you want. I mean, well done. You made a good investment. You made a profit. I think since talking to you more and more, and also since reading about Buffett and Peter Lynch, I'm definitely more in the camp of let the profits run.
Yeah.
Because it just seems like that's the number one mistake that all of these big dogs talk about is that they get out too early.
Yeah. What does Peter Lynch call it? Like cutting the flowers and watering the weeds. But I think the way to think about it is if you've done a good valuation, which is a safe, conservative valuation, then your estimation of value will be conservative. So you shouldn't be surprised if a business with an amazing competitive moat and a great management team, you shouldn't really be surprised in some circumstances if it outperforms your value, right? So, if a business does, goes above your calculation of intrinsic value, it might not necessarily be that it's overvalued. It might just be that the business is doing really, really well. And I mean, in some cases it will be overvalued, but I much more subscribe to how Phil Town talks about managing investments in the second book, which is Payback Time, where he talks about stockpiling, which is this idea that you want to accumulate as much wealth in great businesses. As they get cheap, you buy more. Otherwise, you leave it. Yeah. And then maybe it gets cheap a few years later, you buy more, and then you leave it. And over time, you accumulate more and more wealth in amazing businesses. That's the idea. So that's where I kind of sit. And I'm sure that I actually haven't read The Buffett Way, but I'm sure that's kind of the line of thinking that is in that book.
All right, I'll ask you this one. This one I think was directed at me, but I'll just ask it to you anyway. So Michael Burry or Cathie Wood are often featured in your videos. So I think this must be directed at me because
I've never made a video about Cathie Wood.
Okay, so we got Michael Burry over here saying, oh my God, inflation's going to kill us. Interest rates are going up. Biggest speculative bubble of all time. You guys watch out. It's coming. And then we've got Cathie Wood that's saying, but the place to be is in technology companies of the future because they're going to lead the world, with all their amazing innovation. She's all in innovation, pretty much. Whose financial advice / warnings do you trust the most and why?
Yeah, well, I mean, I definitely would lean more towards Michael Burry just because he's more of a value investor than he's not a strict, Warren Buffett value investor, but he leans more value than Cathie Woods does for sure. Yeah. I mean, there's really no value investing involved in, as far as I'm aware, in almost anything she buys. I don't think that price is really a consideration in the kinds of assets she's buying. So in that respect, I definitely lean towards Burry more than Cathie Woods, but I mean, in terms of whose advice do I trust the most? I mean, I make a lot of videos about Michael Burry because it's interesting to see what he says. It's not necessarily that I'm following him step for step. I don't even follow him at all, really, in terms of what he actually does. I haven't short Tesla. I haven't done all of these things that he's done. But it's interesting. He's a contrarian. He's out there. His views are always massively different to main Wall Street, to down through Wall Street, Main Street, and it's interesting to watch. That's really why. And other people find it interesting as well. So it always, videos do well. So
yeah. so at the end of the day, I get good views.
So in conclusion, I do it for money. No, but I find him so interesting. Same with Ray Dalio. I find his content interesting.
Yeah.
Munger always has something ridiculous.
He's always ripping into somebody or something.
He's talking about Bitcoin as rat poison or something. Like they just have interesting perspectives. And whenever it comes to macroeconomics, which is what Ray Dalio is big into and what Michael Burry is big into, I don't invest based on that. I'm investing based on the individual business. So that's kind of my thoughts on that.
Yeah, I think. I don't. The way that this is worded, who do you trust more? I don't trust, either of them. I don't follow, who would you copy more? I don't copy any, who. At the end of the day, we're free thinking people that make our own investments. But I'm going to be a little bit of a fence sitter here. I actually think both of them are right in their own ways, because Cathie Wood is kind of like looking out long into she's like living in the future. She's like 30 years down the road. She's investing in like CRISPR technologies and DNA editing and that sort of stuff, and Tesla and all these big companies that have bright futures and growth technology companies, all of which might be horrifically overvalued, yes, but she's like living in the future. And taking that approach, she might just be right, because those are the companies that are pushing the forefront of innovation. Some of them will fail, of course, but maybe some of them will succeed because they're innovating so much. I mean, if you're innovating, chances are you're going to hit something that consumers like, that maybe makes their life better in some way or more efficient, and then that thing will take off. So, while I might say that her portfolio is maybe a little bit expensive, she might be right down the track. But then again, I also think Michael Burry's right, because he's very rational, but of course he's saying things like, inflation's going to sting. Yeah, I probably do believe that. The market is super speculative. Yeah, I probably do believe that as well. It might crash at some point and might see a significant fall off. Yeah, I probably do believe that. Obviously, we can't predict anything, but I probably do believe that might happen across the next few years. Yeah. So I kind of believe both of them, but they do kind of butt heads sometimes.
Yeah, I think I used to, when I first got into value investing a few years ago, I thought it was, and it is, I think value investing is really great, but I think I thought it was like the only way that you can succeed in investing. Like I just thought like, oh wow, this really is
my way or the highway.
Yeah, exactly right. So I think, a few years ago, I would have been much more critical of someone like Cathie Woods, but it's just a strategy that I don't understand. And there are, people make money using value investing. People make money buying hundreds of different businesses. Most of them don't do well. And then one of them does 10,000% and the portfolio overall does extremely well.
Yeah.
I was just reading about John Templeton, who made a number of those investments he invested in 100 different businesses during World War II, most of them on the brink of bankruptcy. A couple of them were already in bankruptcy.
Wow.
And his broker said, so you've given us this list of 100. I've eliminated a few because they're already in bankruptcy. And he said, no, I want those too. And he took them all, and I think he made 5 times his money on average through that basket. So, it's just an example of that's not value investing. That's not Munger style value investing, but it worked, and he was an amazing investor. So I kind of take that view where I don't understand it. It's not my cup of tea. Investing in a basket of speculative, futuristic companies that are not doing too much now, but have this hope of the future. But who am I to say that doesn't work?
Yeah. And if you're a super critic and, you take a stand and you're like, oh no, Cathie Wood's oh no, that's rubbish. That's never going to, you'll probably get stung in 20 years because you might look back and be like, oh, her portfolio outperformed mine by like 10 to 1. Damn. But yeah, I think you're right. It's just, people can make money in the stock market in a variety of different ways. I mean, we think that day trading is stupid. I mean, we think it's just the most bizarre thing. Why would you do it? I mean, most people don't make money in day trading, but some people do. It's like some people do. So there's a million ways to make money in the market. I'm not a huge options trader. People, make huge sums of money options trading.
Yeah,
it's
exactly
just
right.
Yeah, we just subscribe to value investing, whereas other people subscribe to other stuff. But Who are we to judge, Hamish? Who are we to judge?
But in conclusion,
But in conclusion,
if you're an investor in Rivian, I'm coming for you.
hashtag ad.
Have you heard of ARK Invest?
Yeah, well, let me tell you, Kathy Wood is a revolutionary investor. Her portfolio is full of really promising growth companies. Anyway, should we wrap it up?
We should wrap it up.
should wrap
Thanks everyone for tuning in, man. These always go so fast.
It goes very fast, doesn't it? We've been talking for an hour and it feels like it's been 5 minutes.
I think I'm gonna have to come up to Canberra relatively soon. We'll do another one. Yeah, because I haven't actually been up to Canberra in a while, and I definitely haven't been up there to do a podcast with you. So
no, that's true. Yeah.
We'll have to do that. It'll be fun. Thanks everyone for tuning in. If you're following along with audio or video, whatever it is, head over to the YouTube version, leave a like, hit subscribe if you want. Hit that subscribe button.
Smash that.
Hit that subscribe button. Thanks Sharesight for sponsoring as always. Sharesight.com/young investors. Go check it out. You won't regret it.
We promise.
We promise. Well, I guess you might, but
you may regret it, but we don't think you will. Hashtag ad.
Don't sue us. Amy said I wouldn't regret it,
and I did. No. And thanks for having me over to your place as well.
No problem. It's been great. Yeah, fantastic.
All right.
We're gonna go get some food.
Yeah, we're starving. We are so hungry. All right. Peace out. Goodbye.
See you guys.